Hello, today is Thursday, June 4th, 2026. Here is your daily signal. The United States says it launched strikes on Iranian radar and drone sites after Tehran brought down an American drone over the weekend, according to the Associated Press. Tensions escalated quickly, with Iran claiming responsibility for firing missiles at American forces stationed in Kuwait, a move U.S. officials say was successfully intercepted on Monday. This sharp uptick in hostilities comes after months of deteriorating relations, largely sparked by the breakdown of indirect nuclear talks in May. Both Washington and Tehran ramped up their naval activity in the Persian Gulf, building on years of mutual suspicion following dramatic incidents such as the 2020 U.S. strike that killed General Qasem Soleimani. Compounding these tensions, robust U.S. sanctions continue to limit Iran's oil exports and pressure its financial system. Key decisions in the region are being made by President Joe Biden, who commands U.S. military action, while Iranian President Ebrahim Raisi orchestrates countermeasures and messaging from Tehran. U.S. Central Command remains on heightened alert, overseeing all American operations, as the national Iranian oil company feels the economic strain of increased sanctions and disrupted shipping. Among the most recent developments, on June 3, American forces intercepted an Iranian vessel allegedly carrying missile components near the strategic Strait of Hormuz, and just a day later, the Iranian Revolutionary Guard staged major naval drills off Bandar Abbas. The U.S. State Department responded by issuing a travel warning, citing heightened risks for the entire Gulf region. In the near term, there are serious fears of global oil supply disruptions, especially if shipping lanes through the Strait of Hormuz are affected. Continued hostilities could further destabilize Middle Eastern security, jeopardize foreign investment, and elevate the risk of a direct U.S.-Iran military clash. Sustained conflict may also worsen Iran's economic hardships and spark new waves of refugees seeking safety abroad. Next, we turn to the choppy waters of global oil prices, where war-fueled uncertainty continues to sway markets. As outlined by Business Insider, Brent crude futures have dropped roughly 20% since late March despite recurrent threats to shipping through the Strait of Hormuz. When tensions escalate in the Middle East, origin of over 30% of the world's oil supply, even rumors of trouble send shockwaves across trading floors. Historical memories of the 1973 oil embargo and past attacks on tankers hover over today's headlines, with volatility visible in both benchmark contracts Brent and West Texas Intermediate. Major supply chain vulnerabilities become acute during armed conflict, inflicting ripple effects on the spot and futures markets alike. OPEC, led by Saudi Arabia, remains pivotal in adjusting quota policies to calm or tighten markets, while major oil companies such as ExxonMobil, BP, and Shell rapidly recalibrate distribution networks in response. Notably, a 2% surge in oil prices was reported on June 4 after missile strikes near Hormuz halted tanker traffic. In response, Saudi Aramco slashed its output by 500,000 barrels per day in a move highlighted by the Financial Times. Meanwhile, the U.S. Department of Energy warns that markets face a period of elevated volatility and possible diesel shortages if trends continue. In the short term, oil price spikes are pushing up transportation costs and raising inflation risks worldwide. Strategic reserves may be tapped, and talks between major producers could intensify if the disruption persists. At the same time, supply chain snarls may slow down manufacturing in energy-hungry sectors across developed and emerging economies. A protracted crisis is likely to accelerate investment in renewables, as governments and corporations re-examine their vulnerability to fossil fuel shocks. Finally, onto the tech world, where fierce competition for AI leadership is fueling extraordinary fundraising efforts. TechCrunch reports that Alphabet is planning to raise a staggering $80 billion to accelerate its AI infrastructure development. This is just the latest salvo in an ongoing capital arms race among tech giants, as generative AI tools and large language models demand ever more robust cloud and compute resources. Over the past 2 years, the pace and scale of capital inflows have grown, spurring innovation but also concentrating power among a handful of firms. Regulatory agencies around the world are watching closely, concerned about how surging investment and fast-evolving infrastructure could tilt the market and impact national security. Microsoft, Google, and Amazon are all racing to expand their digital empires. Microsoft, for instance, has just earmarked $4 billion for new AI infrastructure in France, according to Reuters. Amazon is raising another $3.5 billion to build out its AWS AI capabilities, while Google has entered into a $2.5 billion partnership with TSMC to support advanced chip manufacturing, as reported by TechCrunch. The near-term consequence will be intensified competition and the surge in AI offerings, but there's also a growing hurdle for smaller competitors who may not match these colossal capital requirements. Regulators could respond with new antitrust actions and oversight as infrastructure concentration sharpens focus on market dominance. At the same time, the pace of technological breakthroughs, especially in chip design and scalable AI compute, opens up fresh possibilities well beyond the tech sector, potentially transforming healthcare, logistics, and industrial automation in the years to come. Now, onto the markets. International markets showed mostly modest gains, with France leading major European indexes higher as EWQ rose 1.7% and Germany's EWD up 1.3%. Largest jump was seen in Netherlands, where EWN advanced 1.3%, while Hong Kong's EWH lost 1.3%, and Taiwan's EWT declined slightly. Commodities presented a mixed picture. U.S. oil USO tumbled 2.9%, while platinum PPLT surged 2.0% and natural gas UNG soared 3.5% to lead the sector. In the S&P 500, healthcare Roman 45 outperformed with a 3.1% rise, finance XLF climbed 2.6%, and semiconductors tracked by SOX declined by 2.1% amid sector rotation. Among favorites, Oracle jumped over 2.6%, while AMD fell 3.6% and Micron MU dropped 7.7% on heavy selling. Standout movers included Ceridian Technology STI, surging 390% to top the gainers board, and Hub Cybersecurity Hub, which plummeted 72% for the session, leading the day's biggest decliners. That's it for today. You can find more news and details on our website. Goodbye.